Hello, and welcome to our in-depth analysis of Fastenal Company, ticker FAST. Today we're diving deep into two critical aspects of financial health, working capital and liquidity. Fastenal is a well-known industrial distributor, and understanding how they manage their short-term assets and liabilities is key to grasping their operational efficiency and financial stability. This session is designed for individuals, entrepreneurs, and financial professionals looking to sharpen their financial literacy and make more informed investment or business decisions. We'll explore Fastenal's unique business model and then break down its working capital components, analyze key liquidity ratios, and discuss the implications for its overall financial health and future prospects. Let's get started. Let's begin with the basics. What exactly is working capital? Simply put, working capital is the difference between a company's current assets and its current liabilities. It's a vital indicator of a company's short-term operational health and its ability to fund day-to-day operations and cover short-term obligations. Positive working capital suggests that a company has sufficient liquid assets to meet its short-term liabilities, indicating financial stability. Conversely, negative working capital, while sometimes intentional in specific business models, can signal potential liquidity issues if not carefully managed. Understanding this fundamental concept is crucial before we delve into Fastenal's specific numbers. To properly analyze Fastenal's working capital, it's essential to understand their business model. Fastenal is a leading North American wholesale distributor of industrial and construction supplies. What makes them unique is their extensive network of approximately 3,300 in-market locations, including on-site customer locations and Fastenal-branded vending machines. This decentralized approach, coupled with their vendor-managed inventory or VMI solutions, allows them to maintain direct customer relationships and deliver supplies efficiently. This model significantly influences their inventory levels, accounts receivable, and overall cash conversion cycle, which are all key components of working capital. Knowing this context will help us interpret the financial data more effectively. Let's break down the specific components that form Fastenal's working capital. On the current asset side, the primary elements are cash and cash equivalents, accounts receivable, money owed to Fastenal by its customers, and inventory, which for Fastenal includes a vast array of industrial and construction products. Given their distribution model and VMI solutions, inventory and receivables are particularly significant. On the current liability side, we mainly look at accounts payable, which is money Fastenal owes to suppliers, and accrued expenses. Understanding the proportion and trends of these components is crucial for assessing how efficiently Fastenal manages its operational cycle. Now, let's examine the trends in Fastenal's most significant current assets, inventory and accounts receivable. Due to their VMI and on-site dispensing solutions, Fastenal often maintains higher inventory levels to ensure product availability for customers at their point of use. While this can increase carrying costs, it's a strategic move to enhance customer service and lock in long-term relationships. Accounts receivable, on the other hand, tend to be stable and efficiently managed, reflecting strong customer relationships and effective credit policies. We observe Fastenal's commitment to efficient asset utilization, balancing the need for immediate product availability with careful management of outstanding payments. These trends directly reflect their unique service model. Moving to the current liabilities, our primary focus for Fastenal is accounts payable. This represents the money Fastenal owes to its suppliers for goods and services purchased on credit. A company's ability to strategically manage its accounts payable can significantly impact its working capital. Fastenal, given its scale and purchasing power, often has the ability to negotiate favorable payment terms with its suppliers. Extending payment terms within ethical and healthy business practices effectively provides Fastenal with short-term, interest-free financing, allowing them to hold on to cash longer. This float can be reinvested into the business or used to reduce reliance on external financing, thereby positively impacting their working capital and overall cash flow. This reflects a disciplined approach to managing supplier relationships. Let's transition to liquidity ratios, starting with the current ratio. This ratio is calculated as current assets divided by current liabilities. It's a fundamental indicator of a company's ability to cover its short-term obligations with its short-term assets. A generally healthy current ratio is considered to be between 1.5x and 2.0x or higher. indicating that a company has at least $1.5 to $2 in current assets for every dollar of current liabilities. For Fastenal, we often see a current ratio in the range of 2.5x to 3.0x, which signifies a very strong short-term solvency position. This robust ratio suggests that Fastenal is well equipped to meet its immediate financial obligations, providing a comfortable margin of safety.
While the current ratio is informative, the quick ratio, also known as the acid test ratio, provides a more conservative view of liquidity. This ratio is calculated as current assets minus inventory divided by current liabilities. The key difference is the exclusion of inventory, which might not be easily or quickly convertible into cash, especially for a distributor like Fastenal with specialized industrial products. By removing inventory, the quick ratio assesses a company's ability to meet its short-term obligations using only its most liquid assets. A healthy quick ratio is generally considered 1.0x or higher. Given Fastenal's inventory-heavy business model, their quick ratio will naturally be lower than their current ratio. However, if it still comfortably exceeds 1.0x, it suggests strong immediate liquidity even without relying on inventory sales.
Beyond static ratios, the cash conversion cycle, or CCC, provides insight into Fastenal's operational efficiency in managing its working capital. The CCC measures the number of days it takes for a company to convert its investments in inventory and accounts receivable into cash, considering the credit it receives from suppliers. The formula is days inventory outstanding, DIO, plus days sales outstanding, DSO, minus days payables outstanding, DPO. A shorter CCC is generally desirable, as it means a company ties up its cash for a shorter period, improving cash flow and reducing the need for external financing. Fastenal's DMI model impacts its DIO, but efficient management of DSO and DPO helps keep its CCC in check, reflecting effective working capital management crucial for a distributor. In conclusion, our analysis reveals that Fastenal demonstrates robust working capital and liquidity management. Their strategic business model, focused on VMI and on-site solutions, leads to specific working capital dynamics, particularly in inventory. However, Fastenal effectively balances these by maintaining stable accounts receivable, strong current and quick ratios, and an efficiently managed cash conversion cycle. These factors collectively indicate a financially stable company with strong operational efficiency, capable of meeting short-term obligations and supporting future growth initiatives. For investors, this suggests a resilient company with predictable cash flows, although continuous monitoring of inventory turns and receivable management remains prudent. Fastenal's consistent performance in these areas underpins its reputation as a sound investment in the industrial distribution sector.